I'm Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources Podcast.
So you've been watching the market at all, and we assume you have been, or you probably wouldn't be on our podcast.
There we go.
This has been a challenging couple of weeks. We've had the fastest drop in a long time, just over the last couple of weeks. Markets have frightened many investors. And of course, that gives lots of advertising media for publications to scare you about the coming market.
That's their job. Yeah. So,
Well, and having known some publishers, they explained to me years ago that the way they raise subscriptions is by using fear. Fear sells
there
subscriptions.
you go.
There you go.
And two or 3 years later, people decide the fear wasn't justified, so they don't subscribe. Which means when subscriptions are falling, you run a new fear campaign
Got to get something
to
else out
bump.
there.
That's right. And what we've seen lately has been the mainstream media promoting the damage that tariffs will do to the economy and how it's going to aggravate inflation. And people already have enough problems. We should never have elected President Trump. Otherwise, we would be trouble free. I'm not quite sure that sells real well right now, but that's the
Right.
attempt.
Uh,
But but when we're looking at particularly volatile markets, but any market, we actually need to step back and give it a minute, if you will, to be sure we're looking at things in context. It's no different than listening to a friend describe a personal situation or crisis or a study you're doing. You don't want to take a single line out of context and make it a foundation to whatever you're doing.
True.
So let's do that with the markets, because the day we're recording this is the day after the S&P 500 set a new low for the year-to-date performance. Basically, we're watching the Trump bubble post-election get undone. We have the NASDAQ down. We have the S&P down. I just referenced that. The Dow has been up and down. You, if you're an active trader, you say, I should short that. And then the next couple of days, you're saying, man, I'm glad I did not do that.
and that's volatility. That's what you have to watch out for. And those are times when sometimes a little patience can be your best friend.
We're subject as human beings to emotional responses to lots of things, and particularly when we have money on the table.
Exactly.
You have money invested in the stock market, you've got a 401k or an IRA, and that's your retirement money. You're already retired, and you're relying upon that for your what's left of your future financial situation. Emotions get pretty extreme at times. And when that happens, we don't necessarily make good rational decisions. And one of the things that does compromise our ability to make good decisions in the market has been a subject of a great deal of academic study about how we remember the market. Now, if you're talking to your spouse, they will probably argue that you don't remember anything you're supposed to.
Ever. Yeah.
And you spend a lot of time apologizing. But when it comes to, even when you know you're right, you're still going to apologize just to get past the issue. But when it comes to the market, we have what's called hindsight bias. I remember I made a good decision when I bought that stock. It was dominating the news, it was dominating sales. Think of Apple over the years. Oh, in recent years, think of NVIDIA, even before it became an artificial intelligence driven stock.
Sure.
It was a gaming driven stock, and it had some really good runs. But with figuring out that its newest chip was really better at artificial intelligence, it has become a stellar performer until recently. And right along with the other technology stocks that people have purchased because they believed in them and they use their products. those stocks are no longer in favor in the last, I'll say 2, 3 weeks.
Right.
Is that a big deal? Well, it is if you're relying on them to continue pushing the indexes into new highs because they are being unwound in the marketplace. The biggest winners that we remember in recent years are now the biggest losers. And we don't often take time to think about that. But this chart clearly shows what's happened here with the major components of the S&P 500, which happen to be the major components of the NASDAQ because
Same.
they're
Sure.
the same stocks.
Yeah.
And if you keep this in mind that you own these big winners, you may be in for an extended period of time where you're owning laggards. And there's other areas to be invested in that are outperforming your favorite hindsight bias assets, portfolio positions.
And that's especially true if you've become emotionally attached to those holdings and you just can't bring yourself to make a change. Even when you're looking at the data and you're telling yourself, you know what, this is not going well, but it did. It was great. It was going great. And I'm just going to hold on because it's going to be great again. And the problem is you don't know when that's true. And once things have moved enough that there are other things doing significantly better than them, that's when it's time to do a little rotating. And don't forget, if you take something out of your portfolio, that doesn't mean you leave it out forever. That just means it's out for now. And those are the kinds of decisions that can really protect you on the downside when it's time for that rotation to take place and you make a change in your portfolio versus just buy and hold and writing it out, which there are plenty of historical precedents where it could take you 10 years or more to get whole again because you didn't do anything when the data said you should. And that's what following your emotions can do to you. That's why we try not to do that. That's why we have rules in our portfolio that we follow to try to keep us with on the better probability side of making good trades.
Well, you mentioned rotation, and that's important because most people do not rotate their portfolios.
Right.
They rebalance them. Typically, investors that we talk to have come from advisors or websites where they answered a series of questions and the advisor or the website, which is basically the same thing, said, well, based on your questions, this is the way we should structure your portfolio.
Right.
They don't tell you why, other than you answered some questions, which basically went into a really rudimentary algorithm because there's a cheat sheet for how to weight your answers. You
Right.
answer question A with a particular answer, and they'll give it a 1 to a 5 point weight. And you get through all the lists of questions and they total up the answers. And surprise, surprise, you end up with a 60-40 portfolio, 60% stocks, 40% bonds. Now, they don't tell you that for 4 years, bonds have been losing money and there was absolutely no benefit to be in bonds for the past 4 years. But that's irrelevant because they're actually looking at data from the 20s
Correct.
to figure out how to structure your portfolio. So when major changes occur in the market, you're stuck holding stuff that makes no sense as far as the current economy and the current market is concerned. And the majority of investors are selling something that you're hanging on to because they're paying attention and your advisor is saying, you just live long enough. Oh, they don't say that, do they? They just say, no, the market always goes up. And so you'll be okay, in parenthesis or under their breath, if you live long enough and don't need the money before then. Because Perry, you just mentioned sometimes the market can take 10 years to recover or
Sure.
more, you said.
Sure.
And if we go back to the 2000 market, the tech bubble falling apart. Now, while it topped in March of 2000, it didn't fall apart for a year. It just went sideways. And then it collapsed for the next 2 years. And it was March of '03 before the bad news was really in and over. And the NASDAQ's down almost 90%. The S&P's down more than 50%, and you're supposed to hold through that, hold your nose, don't look at your statements, don't call your broker. He doesn't want to talk to you, and you don't want to talk to him.
Right.
When in fact there were technical signs in the market. There was actually, you didn't need to have a lot of technical knowledge. You just simply had to look at what's working right now. My stuff isn't working. There must be something that is.
Right.
So rotate the portfolio to what is working. And while the US market has been falling apart over the last couple of months, well, say the last month, because January is pretty decent. But
Correct.
since then, we've been in a downward weakening trend, which seems to be accelerating. We don't know if it will continue, but the odds right now are in favor of a lower price before this turns up. By paying attention to just the simple returns over the last several weeks, the last month, even the last quarter, what you would see is that international investing is doing much better than the US market investing.
Yep.
Now, maybe you own a little bit of international, but if you have been structuring your portfolio based on the modern portfolio theory academic studies, you don't own much international.
Correct.
But maybe you should own a whole lot more and a whole lot less of the US, and certainly maybe not even any technology. Those are all options which, just following return performance, can reduce your risk. Maybe you'd go to cash. Maybe you just raise some cash. It doesn't have to be an all or nothing situation.
But
And and
Perry,
that's a huge change.
we get a
It's
lot
it's
of
a it's a it's a, it's a huge change in your portfolio from what it has been. It's been completely technology driven. It's been completely US based. And now we're seeing a rotation completely away from that. That's a difficult change to make when it has been so profitable to be where we were. And that's when you really have to have the rules in place. You got to follow the data. You have to follow the rules. You have to get your emotion off the table. And then you can make the decisions that can help protect some of the gains you've made and have you in a position to continue to profit even during the market volatility. And even if you're not going to profit, maybe you're going to, the downside is way less than the biggest winners, which tend to see the largest losses when those turn around. It's just psychologically so difficult to make that change because it has been so good. And so people anticipate, just like when the tech bubble busted, it's the people anticipate, well, it'll all come back. It'll be fine. This is just a buy the dip situation and everything's going to be fine. You never know that till later. You never know that till later. And if the data is saying, no, this is not that kind of situation, you need to make that rotation. And the only way you can logically do that is if you're tracking the data, you're following the trend, and then you have the discipline to go in and make those trades because the rules say we've moved enough. It's time to make the rotation. That's what we do. We try to stay out of the way and let the model work. And that's been the best thing that we've been able to do for our clients.
One of the things that causes anxiety is the volatility that we've had recently.
Yeah.
But what we need to recognize and accept in our own brains is that we need volatility in the market in order for the market to advance to new highs.
There you go.
So emotionally, we want something that looks like the graph on the left-hand side. But what we really need for our portfolio growth is what's on the right-hand side. If things are always orderly, we are not making progress. Um, yeah, I'm thinking of somebody who's in the news and recently with a lot of disfavor, Elon Musk.
Sure.
But,
Sure.
but I'm not thinking about Elon as much as I am thinking about what he's done with SpaceX, getting spacecrafts into space and capturing his main boosters in the chopsticks as they come back to Earth.
Right.
Right. Instead of what we've spent 50 years of NASA doing, running them up into space and dropping them into the ocean and saying, oh, there's the several billion dollars that we don't need anymore.
Goodbye. Yep. Goodbye.
So high entropy is actually the way that I think Elon Musk thinks about all his multiple businesses.
Sure.
If he's not changing things and if things aren't disruptive, we're not making progress. So when we go through these periods of volatility in the market, think of the volatility as a benefit.
Correct.
Maybe the benefit is it forces you to look at what you're doing and realize return performance is someplace else. And it's time to rotate the portfolio and make, as Perry you just said, some tough decisions because they may be tough emotionally to make, especially if you have to take a loss on something.
Right. But that's why we have rules. That's why you have to have the rules because that's going to make you do things even you don't want to do. But when the metrics hit and the rules come into play and say, here's the move you're going to make, you have to have confidence in your model and go ahead and do it. And that's how you stay ahead. That's how it works.
If you want to know more about how we do that, you can give us a call. The contact information is going to pop up on the screen. If you haven't subscribed to our podcast, please do so. We've got more coming up. We're publishing at least twice a week, and it'll keep you up to date on issues that we're looking at. But stay in touch. We'll be back shortly.